Welcome, everybody. I guess everyone here at some point has had Bitcoin, and hopefully over the years you've seen it grow to probably more than what you thought in your portfolio. So the question always is, now, what do you kind of do with that? And at Xapo Bank, we allow you to custody it. You can also borrow against it, and what we're going to talk about today is, of course, earning some kind of revenue against that. So with the Byzantine Fund, what we chose was a regulated structure. Pretty much everyone else has done that as well here. So these are, some of the biggest asset managers in the space. So, to start off, let's just chat about everyone's strategy, a quick introduction on what you do, and maybe we start with you, Fabio.
Okay, I'm Fabio Frontini. I run Abraxa Capital Management, the ECA Funds family of funds, where we have, that is the topic of this panel, like the Alpha Bitcoin Fund. It is probably the largest Bitcoin, regulated Bitcoin in the world at the moment. We manage about 27,000 Bitcoin at the moment, and we have a target return between around 6% per year. And I think that's pretty much it. I will keep it short.
My name is Evgeny. I'm the CIO and founder of 37 Capital. We're a DeFi hedge fund focused on deploying capital on chain. We've been running for about 5 years with a dollar-denominated strategy, and last year we rolled out a Bitcoin-denominated strategy where we either source dollars from BTC through borrowing, for example, or we deploy, and then we deploy these dollars via stablecoins on chain, or we deploy Bitcoin in various wrapped versions on the blockchain, earning yield directly from DeFi. We run a variety of strategies and with about $500 million of assets.
Good morning, everyone. I'm Barnali Biswal. I am the CEO of Hilbert Group. Hilbert is a listed asset manager focusing on crypto. And like many of my panelists, we have both systematic as well as discretionary strategies that typically focus on alpha generation, and we also manage the Xapo Byzantine Fund in partnership with Xapo Bank.
Hi, I'm Deepak Gulati. Believe it or not, I'm Swiss. Perhaps don't, but I'm still in the World Cup. Probably till tomorrow. Or at least we're still in the World Cup. We run a work for Adam and Co. I think everyone knows Adam in this room, and everyone's talked enough about Bitcoin. We harvest yield through an expertise in volatility. I've been doing this for 26 years. I was the global head of prop worldwide for JP Morgan for a long time, then had my hedge fund, and now a year ago was approached by BCIS. And brought a team of many people, and so we rely on heavy technology, understanding volatility, and the key point I want to make is we are not selling premium, we are actually long gamma, long volatility, so building a convex profile, which might sound like a holy grail, but we try to do that and target yield, high single digits on a one leverage.
Hello, I'm Francesco from Fasanara Capital. Asset manager based in London, regulated 6 billion in assets under management. We trade both cryptocurrencies. We do both crypto and fintech. In fintech, we do short-dated credit, quite systematic, tech-enabled. In crypto, we do alpha strategy. We extract alpha in all possible ways from the crypto markets. Cross-exchange arbitrage, basis trading, funding, and treasury yields.
Okay, thank you. Is this better? Can you hear me? Okay. All right, Barnali, we're going to kick off with you. Just want to know how you performed year to date, what strategies are currently working well, and just with regards to the Byzantine Fund, how has the stable yield resonated with investors, particularly since 10th of October last year?
Yeah. The first part of the question, how the year has been, clearly since October last year, the overall market structure has shifted, and therefore a lot of the previously performing, specifically statistical arbitrage type of strategies have performed poorly, actually, year to date. However, with the volatility, the newer opportunity set has also appeared. So I would say that you do see appropriate dispersion in performance among the managers who are more sophisticated, better risk managed, and have better processes. Year to date, Hilbert's flagship product, which is something we call Basis Plus, the Bitcoin share class, is annualizing about 7% compared to last year at around 20%. So substantially more muted, still, performing very, very well as compared to the spot. And if we look at Byzantine Credit Fund, that value proposition is a little different. What the consistency of performance, especially in stressed market conditions, that is where we have seen most of the investor focus has been. And I'd just point out that in crypto, of course, there is optically attractive yield, but then there is yield that's actually institutionally underwritable. And Byzantine essentially has proven to be of the second category. And because there is that consistency, we are definitely seeing more sophisticated underwriters turn to sort of the more non-dilutive yield generation on their passive holding. So, yeah.
Okay, thanks. All right, Deepak, next question for you. I guess relatively new entrant to the market. I'd like to know how you are positioning yourself and how you would define your edge within this space.
Yeah, I don't like Bitcoin at all. No, I'm kidding. No, I don't know if it's because I'm, Indian, Swiss. It was an easy transition from being very long gold to going to digital assets. I don't know, it runs through my veins. How are we positioned? I was selling that to Alex because he was carrying an umbrella yesterday. We see volatility as an opportunity. And people who live in the UK probably know that you need an umbrella every single day. You don't know whether it's going to be sunny, hailing, or rainy. And that's what I call long convexity, long gamma. How are we positioned? Exactly that way. We are long vol in some of the products. How do you finance that vol is key to have the understanding, because in general, in any asset class, implied volatilities trade at a premium to realized volatility. So in general, you would expect to be negative carry. So how do you structure that? It's all about structuring. But volatility is an opportunity, as we've seen in the last few weeks. The reality is, I've heard a lot of people speak about BTC. We don't try to take it a directional position. We leave that to the smarter guys and the big boys. We try to harvest the price volatility. And right now, from what I've heard, there is no consensus. Some people, my boss, obviously, let's call him Satoshi, but yeah, is it going to $1 million from wherever we are right now, 58? We just came from, 120? The price halved. I think that's called volatility. Can we be back at 120,000 in 1 year's time? Absolutely. And to be able to realize that, you need execution system, you need technology, CTOs, and you need to be fast. And more than anything, you need very good risk management capabilities. And what we focus on is being in the top of the class in risk management.
Okay, thank you, Deepak. This next question for you, Fabio. I guess definitely largest, most consistent fund. Would love to hear what you attribute that to, and how do you see scale as you look to increase that?
Very good question. How do I see it? Scale is the challenge, to be honest, in this market, because people thinking, okay, you run like a 50 million fund, 100 million fund, whatever. It changes completely when you run a 4 billion fund, actually, running the same strategy. So managing the complexity is the most difficult part. Strategy-wise, I mean, depending on the market environment, there are like strategy that works in, let's call it bear market, where we are right now, and strategy that works better actually in bull market. I tend to marry a little bit what Deepak is saying. I think volatility is alpha, actually, the alpha you can extract. And I will add the fact that actually if you have like a classic Bitcoin yielding strategy, like so basis trading, lending, and this kind of trades, arbitrage, etc., you can use this one actually to finance long gamma position, as Deepak was saying. Is a very attractive for Bitcoin. I'm actually like the idea that there are like new players in the market that are coming that are short vol seller. So because that is that creates more opportunity for people like me actually to make more money eventually and to produce more yield on the Bitcoin itself. But yeah, I think is challenging, but it's not impossible. I think the fact that I'm here talking with you guys and managing like this strategy since 2018 and being so successful in terms of return and the asset under management is a proof that can be done. Yeah, it can be done, and there is space. Obviously, the market sometimes shrinks, as was mentioned, sometimes it re-expands. But I think the proof of this conference is the fact that we are all here because we believe that there is a tomorrow. Otherwise, we will not be here. Actually, it's like we will be home thinking about the next trade. So I would say that is my answer.
Okay, thanks, Fabio. Evgeny, we'd love to just chat to you now next about you've recently listed on or launched on the UBS platform, just what that means for you, just the process behind it, and then if you can follow up on just the DeFi outlook for the rest of the year.
Yeah, we sit in this bizarre category of DeFi, which is a whole new way of generating P&L, and in exchange for that P&L, you take very different types of risk, right? Where we're supposed to lose money regardless of what happens in the market, only if there are cybersecurity attacks on specific platforms. And it took us a while to understand whether that risk can be quantified and measured. And having done that, we made the decision to launch our firm about 5 years ago. And it's still quite a niche category, even in our space, where the DeFi sector has grown by more than 100x in about 6 years. But when it comes to deploying capital at scale, it's not easy to do. And it requires a very specialized knowledge base. When I was launching the firm, explaining a DeFi yield strategy to bankers and hedge funds was quite an interesting experience, where they've never done anything on the blockchain. So, coming into their offices with a laptop and a ledger was quite an experience. But once you can demonstrate, 5 years of a very consistent track, this suddenly makes you investable, even for very large, very traditional institutions who frankly don't really care about crypto. They don't really care about, anything. They want to show market neutral returns to their clients with consistency and a regulated setup. So over the last year or so, we've been onboarded onto a couple of wealth management platforms of some of the largest banks. And we're seeing the traction kind of all over the world, all the way from Hong Kong to the States. And when it comes to DeFi specifically and the outlook, it's a very interesting moment in time where the way how we've been thinking about DeFi from a risk-return standpoint has been very, very particular. People allocate capital into DeFi, and assuming they're not taking market risk, they make money as long as the platform which they deposit capital into doesn't get a cybersecurity attack and doesn't get hacked. When you speak to someone who is not in the space, that sounds like a very binary risk and a very scary risk. Right? You put money into the bank, maybe it gets robbed, maybe it doesn't. You just want to avoid that risk altogether because you don't know how to price it. We have, however, developed some research and some models over the years where we've been thinking of this as a credit exposure. Right? You allocate capital across 100 loans, some of them may default. When they default, there's an expected recovery ratio, and so on and so forth. And that ratio as a default rate for the whole sector was low double digits when it emerged, like about 15%. And it gradually went down to about 2%. So imagine you have a sector paying you 15-20% a year with an average default rate of below 5%. And as a manager, you can push that metric down by 10x if you do your job well. With advance in AI, however, there was a lot of anxiety generated in the sector. There was a broad range of hacks this year, where many platforms got attacked, and it's very clear that some of those attacks have been at least accelerated by AI. because AI is, and anyone, I'm sure everyone on this panel and in this room is using agents in some shape or form. And I think most people would probably agree that AI agents don't miraculously, 10x your business. But what they can do is they can accelerate your research by 10, 20, 50, 100x. So then if you're an equity analyst or a positive actor in the space, you can accelerate your research. But if you're a malicious actor, obviously your research goes 10x faster as well. And what we've seen, so we've kind of reevaluated the whole and kind of repriced the whole risk framework. And the conclusion we came to is basically there is zero information to suggest that anything has actually changed in the space. None of these hacks have had any material impact, and in fact, the kind of annualized default rate is still below 2%, and in line with the previous year. DeFi returns are cyclical like anything else. In a great environment, you're making 30, 40. In a low-yielding environment, you're making barely more than treasuries. But if you can keep performing in an environment like this, generating positive returns when this kind of default rate is still low single digits, then you're positioned well for the next leg up, which eventually kind of comes. And every time we've had this, bear markets and DeFi winter, we chose to double down in this space. And for the first time ever, I think we're going to get a very different forward-looking outlook for DeFi yields, because previously you would only get paid for crypto risk and for demand for crypto leverage and volatility. Now that we have tokenized stocks and tokenized credit, you can earn market-neutral returns when there's appetite for leverage in stocks. And not just in coins. So there's always bull market somewhere, and we're seeing how DeFi yields are going up already.
Okay, thanks, Evgeny. Francesco, this is just for you. In terms of Fasanara, where does the digital asset space sit? Why did you choose a Bitcoin fund in particular? And are there any other plans going forward for the digital asset division?
So Fasanara set out 15 years ago, 2011, as trying to be innovative within the asset management industry, trying to be the new, call it like a Blackstone or Millennium of the digital age. So able to extrapolate alpha in new, innovative ways. And one of the tenets was to utilize technology to enable returns and innovation. And the combination of the two as often as possible. Sometimes you can be innovative without using technology. Sometimes you can use technology without being innovative, but when you find a way to have the two together, is particularly exciting and brings to the market something new, something that is in demand. The other tenet was stable income for institutions. Most of our capital is managed for pension fund, insurance companies, banks, and family offices, so 90% plus is institutions. And so what we thought they would like to see either now or in the future, is a stability of returns, way above the ability for outsized returns. And so instead of just speculate around things, like created these positive, stable, resilient, and scalable income streams. And so we did that in fintech through this short duration credit, and then we set out to do it in digital assets as well. Stability of returns by monetizing inefficiencies in the digital asset space and volatility. Digital assets are particularly volatile, at least more than euro-dollar, and they are particularly inefficient, based also on the presence of retail within it, and that is the reason why we got interested into the space. Then some human side of things, some of us, Nikita, many years ago, expressed the interest to develop this crypto practice, and brought a team together, Alessandro, that they are here with us today. And so he started back then, 7-8 years ago, and then he scaled up with the rest of the firm. It fits very well with this idea of innovation, technology, and stable income for institutions.
Okay, thanks. All right, so next we're just going to focus on everyone's outlook for the rest of the year and how you'll probably position yourself for that for H2. So maybe Fabio, you can kick it off and we'll go this way down the line.
Okay, that's a tricky question to be the first one to answer. How to generate alpha for the remaining of a year. Well, as it was mentioned, there are opportunities. There is always a bull market somewhere. Mm-hmm. That I agree entirely. So you just have to broaden your horizon and always scan for opportunity. It could be DeFi, it could be in lending, it could be a peer-to-peer lending. As you know, markets are cyclical, and there are, as I said before, trades that work very well in bear market. generally speaking, like lending and peer-to-peer lending to people who want to take leverage or want to go, like in the market when the market tanks. They work particularly well. And some basis trading and obviously like, the classic arb between, like futures and this kind of stuff that works in different scenarios. Next, I think this summer is going to be challenging. I agree with Evgeny that did the same. We did the same analysis about, probability of default and, and this kind of stuff, in the light of the acts that we had the first 4 months. And let's put it this way, nothing has changed, but that has scared the market quite a bit. So that has created a lot of capital to move away and to leave, let's put it this way, less liquidity in the market. Now, less liquidity in the market then creates obviously more volatility every now and then. So I think the order of the day is patience, not to overtrade and actually wait for the opportunity, because it's a market that actually, even when you do not expect, it creates enough opportunity for you to generate the yield that your investors are expecting. So, the worst thing you can do right now, in my opinion, is to overtrade. So to stay in front of the screen and try to find something that is not there. Just wait and the opportunity will arrive. It's been like this since the beginning of the times and even in traditional market, and I think crypto is no difference.
Okay, thanks. Evgeny?
Yeah, I agree completely. It's the type of environment where you have a temptation to chase yield, to chase P&L, because right now, whatever you do, with very few exceptions, yields are lower and expected P&L is lower. And these are exactly the moments in time where you start going beyond your risk limits, beyond your mandate, and then you basically blow up. So it's the time to be patient on, if we're speaking with a market neutral lens, then it's a time to be patient, stick to the mandate, and to make sure you kind of survive and perform to the point when cycle actually does turn. And genuinely, I feel pretty excited because there are very interesting opportunities right now in the DeFi space where you can be lending against very secure set of tokenized credit assets, and you're basically taking pretty much, well, not no risk, but basically zero risk in exchange for attractive yields, or you take advantage of the speculative mania in stocks. You just do it on chain. And when it comes to directional exposure, because some strategies we run are directional in nature, I remember when I started in the hedge fund world, I asked my senior analyst a view on a specific stock, and he said, I think it's probably going to go up, but there's a risk it might go down. So I usually stick to that line of answers. But genuinely speaking, it feels that, like for those who don't have exposure to the crypto space, these are the prices at which it's a no-brainer. These are basically no-brainer prices to start accumulating. And I think if you're holding, it's probably a bit too late to get out anyway. So I think patience is a virtue, and we've seen this many, many times before, and we just need to keep walking the walk.
Okay, thank you. Barnali?
Yeah, echo much of what has been said, but maybe coming from slightly different angle, I do think that the overall market, sort of the institutionalization of the market will continue regardless of the ticker price and headlines. And, it does feel like we're obviously dominated by fund flows and other macro factors that sit outside of the crypto. And crypto being one of the more liquid as well as least mandated asset class will likely see the exit of fund flows the quickest when it comes to any kind of risk-off scenario. But having said that, typically when there is a clarity with regards to, or I would say relative clarity with regards to regulation, and sort of better quality of capital arriving, even though they are smaller, but they're just higher quality, there is deeper, more varied, and sustainable set of opportunities that typically arise for high-quality asset managers. So from that vantage point, I think there's a lot to be excited about. And in terms of some of the newer things that we are focusing on, much of our traditionally we've been focused on trading on the centralized exchanges or on-chain on secondary liquidity. Now there is opportunity towards bridging much more via tokenization some of the traditional market price action to the digital asset world. And specifically, I would say tokenized equity is emerging to be an interesting space where we are doing a lot of work. And expect more focus in the second half.
Very interesting. Okay, Deepak.
What was the question again?
Well, yeah.
No, I'm kidding. Outlook. Obviously, I agree with everything that's been said, and the reasoning makes perfect sense. There is less liquidity, which is going to create more volatility, so cannot agree more with Fabio. So the outlook, we are not yet in a completely mature asset class. We still getting there, right? We still don't know what is the right price. We have more uncertainties coming from the macro side on FX, on inflation. We don't know what the rates are going to end up at the end of the day by year end. And there's more and more controversy, discussion on what the Fed is going to do. How is the other central banks are going to react to it, how are the tariffs going to change, the PBOC. So you have real uncertainty in the entire market, with equities market at close to all-time highs, dividend adjusted, we are at all-time highs. When you think about the entire ecosystem is smaller than Microsoft or Apple or Nvidia, or the top 5. And if you're just talking about Bitcoin, you're talking about half of that size. So all I can say is, volatility is here to stay. And one thing I will emphasize on the strategies we run, my best year was 2008, 9, 10, those volatile years. And we don't see that stopping anytime soon, especially if you have less liquidity in the market. You are going to see larger and bigger moves, at least for the foreseeable future, for then to volatility to come off. Now, the one thing I will emphasize, as I said, is our returns actually get better the higher the volatility, not the other way around. So the yield is a mathematical compounding. The higher the volatility, it's not a linear function, it's actually an exponential function, how the returns react to the level of implied or realized volatility, especially realized. It's a squared function, it's not a linear function. So we welcome volatility, and volatility is our friend.
Yeah. Okay, Francesco.
On my side, I'm quite positive. I think it's unclear what the rest of the year will bring. Perhaps new laws, perhaps a moderately higher market. But if I have to guess estimate, I would say 2027 is going to look good. And so patience pays, like my colleagues said here. In this asset class, you need to build for the long term. You're not there to reap a short-term profit. We are market neutral. We believe in market neutrality in ways to extrapolate alpha, not just speculation. Days like these, they show that you should be not speculating, right? Because speculation today would bring despair, right? In terms of price action itself, it's not that particularly informative even, because Bitcoin has gone through large drawdowns 6 times over the last 10, 12 years. By more than 50%. Many of those times were 70 to 80% drawdowns. This one is not even that. And so all-time highs was only 9 months ago, 10 months ago, so not long ago, almost yesterday, let's say. Yeah. So I don't see many reasons for despair, although the market seems every single time to go into that position, right? And think it's the end of it. And there are some technicalities, of course, in the market that we should be aware of. Macroeconomically wise is uncertain as it's always, every single year. There are uncertainties about the central banking policy, inflation, and other things, especially in recent years. And so, all in all, regulatory environment is a lot clearer than before already, even while we wait for the Clarity Act, but it's already a lot clearer than it was. And so, if it gets approved, great. If it doesn't, okay. It will be postponed, but not to an infinite amount of time. And overall, if there is not full clarity, you get to build patiently without as much competition, which is also good from a talent accumulation standpoint, for example. And so I think there are a lot of reasons to be positive. Last time around, when there was a winter, was 2022, really, and big things happened, like the largest centralized exchange, the largest decentralized exchange, one of the largest stablecoin, all at once collapsed, like within 10 months. So that was a real danger, and it led into a 2-year winter. This time around is unlikely to be as long. So overall, positive.
Okay. Thank you, everybody.
Thank you.